want to be respectful of people's time. Good morning, everybody. For those of you who don't recognize me, and I suspect most of you do, I'm Todd Schwartz. I'm the Executive Director for the European American Chamber of Commerce here in Cincinnati. I want to thank you for joining us for this webinar today to explore the WAYMARK Collective. Let me quickly just tell you who our presenters are, and then I'll tell you a little story about how we got here, and then we'll actually get on with the rest of the show. So let's go ahead and look at the next slide. So, like I said, I'm that pretty face there in the middle. Dominic Franchini, I think most of you probably know, he is the Vice President of the Board of Directors of the European American Chamber of Commerce. He will be assuming the position of President come January next year for a 2-year term. But Dominic is also the Vice President of HORAN, one of our member companies, and very, very key player in that organization. We also have with us Shannon Schumacher. I don't know how you say it, Shannon, but that's how the Germans would say it, so Schumacher. She is an account executive. She is an account executive for the HORAN and works out of their Kentucky office. So, like I say, I'll very quickly just tell you a little bit of story how we got here. You know, we talk about the role and the mission of the EACC. I mean, formally in our incorporation documents, the mission of the EACC is to stimulate and reinforce business networking relations between the Cincinnati tri-state region and Europe, and that's a great mission, but it's a little vague. I mean, I always explain to people that the real value of the EACC is our ability to bring people together, to connect them to the resources and the information and the other individuals that can help them solve their business problems. And in that, most importantly, it's just bringing people together to discuss, you know, what are their challenges and to see them find solutions to their problems. So that's our role, that's our mission. It's to help create those connections. It's helping companies find the concerns where they share, where they overlap, find opportunities where they overlap, and then most importantly, working together to find solutions. And that's exactly how we got here. I think it was back in October last year, we had a new Italian company that had joined the EACC, a new investor in the region, a great Italian company called Modula. Their CEO, Antonio Pagano, was in town to oversee some of the operations. I think he's now here permanently. But we wanted to introduce him to some of the other members of our of the EACC, and particularly to his Italian compatriots and the other Italian companies in town. So we put together a dinner with no agenda, no speeches, no presentations. We just got a bunch of Italian company representatives, top executives, together at Lissa Steakhouse in Covington, fabulous food, and had a discussion. We went to our board and said, hey, you know, we're looking for somebody to help us support this event. And HORAN very graciously agreed that they would fund the dinner. And Terry HORAN who runs the company, and Dominic were there. But again, no agenda, just sitting around. And in the course of that dinner, one of the questions that came up, one of the shared concerns that was expressed was companies were very frustrated with healthcare costs. And as you know, most Europeans, their attitudes with regard to healthcare costs are, wait a minute, why do I have to pay for this? Doesn't the government pay for this? You know, there's no national healthcare system in the United States. So again, you know, that was the discussion. That was one of the shared concerns that was raised. The discussions continued after the dinner. And again, obviously, with HORAN being an expert in this field, the discussions continued, expanded. HORAN brought their expertise into the discussions, their knowledge and background. And lo and behold, the WAYMARK Collective is born. The concept is born, and we wanted to, out of that, share the opportunity to the rest of the EACC members to say, look, you know, here's an opportunity for our companies to come together again, to create connections between our companies, to identify and work together to address this shared concern and hopefully create some opportunities for our members both to save money and improve health care outcomes for their employees. So that's kind of my introductory piece about how we got here. Why is the EACC supporting this effort? And with that, I'm going to turn it over to Dominic, and he can walk you through the presentation. So.
Great, thanks, Todd. So I'll walk through kind of the details of the WAYMARK Collective. You know, the reality is this concept that we're going to share with you today had been kind of rolling around in our minds for the last couple of years, yet we had not determined to really build it out and implement. And it was this dinner that kind of said, all right, now there's some businesses here in the community that are asking for it. It's time to go. So it was a real catalyst. And the questions, you know, you see here are not exclusive, obviously, to European companies, nor is this solution as a whole. But we'll get into why it matters about the European community at large. But what if there was a better way to manage your health plan? And what if you could reduce your renewal volatility and receive unused premium? So we've all been in enough of these meetings through our kind of renewal experience to understand you never know what the renewal is going to look like. And in bad years, it's a bad increase. And in good years, they don't give you your money back. You already spent the money and premium. And so you feel like you can't win no matter what. And we are trying to see if we can't create a tool that helps fix those. So I'm going to do a little bit of backdrop here just to make sure we're all on the same page and help kind of frame up what WAYMARK is. But in simple form, there's currently two methodologies that most employers in our market use to insure their health plan. You'll see those first two here, a fully insured health plan and a self-insured health plan. We won't spend a ton of time, but just cover the highlights here. So on a fully insured basis, what that means is an employer is paying a fixed monthly premium directly to the insurance company, and that insurance company is taking on all risk for those claims and all opportunity to earn profits on them. So they're going to take a guess at what they think your expenses will be, charge you for that, and then take on all the risk and reward. What that does for an employer is limit some of the flexibility. So these become like shelf products. You get very little transparency into how your money's being spent because the insurance company retains that as their own detail. And as we just talked, you get rate increases in good years and bad years. We don't see a lot of fully insured health plans getting negative renewals. It happens occasionally, but not very frequently. And the traditional methodology to combat that is a lot of carrier change. So if you're not going to get a good deal from the current carrier, you go to market, and in order to get a more competitive price, you continue to bounce through various carriers. A lot of employers, once they've kind of worn out on the fully insured model, determine that they will explore a self-insured model. And in self-insurance, what that essentially says is, we are going to buy insurance for the largest claims, so we're going to protect ourselves against big loss, but we're going to take on the claim payment expense as the employer. So when my employee or their spouse goes to the doctor or goes to the hospital, we're going to cover that out of our own dollars, and we're going to take the chance that at the end of the year, if there's money left over, we get to keep it. And if we pay more than we anticipated, it'll be less than what the insurance is going to require on a fully insured basis. So you're kind of hedging your bets that if you just pay your own claims, you'll outperform the fully insured market. And in our experience, employers over time who self-insured do indeed outperform the fully insured market anywhere by 3 to 5% over multiple years, of course, a little bit more ebbs and flows. So the yellow box.
Dominic,
go ahead, Tom.
Dominic, let me just interrupt you to remind everybody, we want this to be a conversation. So if at any point you've got a question or a comment, use the chat, use the Q&A. And I just wanted to review, when we rehearsed this last time, we talked about self-insured. And the point on the self-insured is that the company still hires a provider to manage that program for them, to administer all of that. You don't have to take all that on yourself, right?
Right.
Is that how we discussed that?
Yeah. And I've from our conversation, I've added a slide that kind of outlines that. We'll get there in one slide, which is fine. I appreciate you kind of pausing there. And yes, feel free to ask questions as they come up. The thing with self-insurance is over time, it generally beats the fully insured market. The challenges that it creates is a little bit more volatility. So instead of knowing every month what your cost is month after month, some months it'll be more, some months it'll be less. And the result there is this cash flow fluctuation. But there's still a segment of insurance that you're buying, that stop loss insurance, that is your reinsurance for worst case scenario. And if you don't have a worst case scenario, there's still a segment of that spend that kind of disappears. So the question that was posed at that dinner was essentially, is there a better way than the current methodology? Because it kind of stinks and it's kind of frustrating. So one more kind of comment, and then we're going to dive in here just to make sure we're all level set. So what we're really going to be talking about on a moving forward basis in this presentation is a methodology to self-fund your health plan. And to make sure that we all are on the same page, we just want to highlight the 3 areas that an employer spends money today in a self-insured health plan. So to Todd's point, the first area is the cost of administration. So you hire a third-party administrator. Their job is to adjudicate claims, provide customer service, ID cards, all that kind of stuff. And for that, you're paying about 5% of the total healthcare dollar on that service. About 15% of your cost is spent on stop loss. So you're still taking some dollars and you're buying reinsurance that protects the health plan against worst case scenarios. And as an employer, you get to pick kind of the level of risk you're willing to tolerate, anywhere from, like a $50,000 deductible that says we don't want to pay anything over that. Some employers go as high as $200,000 or $300,000 in our market. And so you kind of get to pick your risk tolerance. But then 80% of the dollar is spent on employee claims. That's the dollars paying the physicians, the hospital charges, pharmacy expenses. And so you really want to think about how can you, if you want to normalize your cost and reduce your cost, where do you spend your energy? And the obvious answer when you look at it laid out this way is that, well, if you want to save money, you have to impact employee claims. That's 80 cents on the dollar. The stop loss insurance is a small portion. That's 15%. And administration's 5%. What we see employers do is that, the easy thing to go to market and compete over is the admin costs. Let's make the TPAs reduce their fees. And we spend way too much time trying to pinch pennies on that first category, and we kind of miss the point of 2 and 3. So now that we've level set there, we want to spend some time talking about the WAYMARK Collective. This is the topic kind of highlight, and hopefully we have laid the foundation appropriately. So the WAYMARK Collective, what's a WAYMARK? WAYMARK is a signpost marking the route of a footpath. The posts you see on a trail with arrows that say which way. And what we're trying to do here is kind of show employers a new path. The idea of the collective is that we are grouping insureds together in partnership to achieve a common goal. And so the WAYMARK Collective as a whole, its intent is to join like-minded employers committed to group purchasing stop loss, actively managing and sharing risk, and ultimately reducing cost and volatility. So, I was thinking this morning, the idea of the WAYMARK Collective is kind of like Costco. Like, how do we put together a bunch of members, use that member volume to drive down the cost of the product, and then continue to produce more value for members of the club? And so what we're talking about now is boring as it sounds, an insurance club. What you get from that is a few key highlights: renewal stability, cost control, more transparency in your data, reduced overall risk, more predictability. And at the end of the day, if we perform well, return of that premium that you're spending on stop loss insurance. These are the objectives of the WAYMARK Collective. So how it normally works. So you've got here mine and theirs. What that essentially means, if we start from the bottom up, when a claim is incurred, the employee pays all claims up to that predetermined claim level. So as we mentioned before, 50 to 250. And then if you have a large claim, you have the ability to pass that claim to the insurance company. So you pay them a premium, the company pays the large claim, they return all risk and retain any excess premium for the claims that you're passing to them. In the example of a real claim, in the current scenario, you've got ABC employer purchases a $50,000 specific deductible. For that, they pay the insurance company for protection over 50. If you have an employee, Jane, who experiences a $600,000 claim, in the current scenario, you pay the first 50, and then you pass to the stop loss company $550,000. So that's how it works today. What we're talking about is a risk share, using these companies in the WAYMARK Collective to pool funds, reduce buy-down cost, and then share the risk volatility. So what we've done is add a layer here. You've got mine, then you've got ours, and then you have theirs. So in the previous example, 100% of the premium goes to the insurance company to pay that $50,000 or greater deductible, or claims after that deductible. What we're doing here is implementing a layer of risk share after you pay your own claims, where WAYMARK's going to keep essentially 60% of the premium that used to go to the insurance company. Now that 60% is being retained and shared by all the employers in WAYMARK. And we're buying up essentially the deductible that says, after your claims, we're then going to share the next $300,000 in large claims. And the intent is that those 60% of premiums is enough to cover any claims risk across the pool. And it's not until after that $300,000 corridor that the insurance company still pays the remaining balance. So there still is ultimately a protective layer in the event that there's a catastrophic claim, but we're taking back to the collective 60% of the dollar that used to go to the insurance company on the stop loss side. So how does this work for the same claim that we talked about with Jane? Jane's still at ABC employer. They have a $50,000 claim risk, $600,000 claim. In the WAYMARK Collective, the way it looks is the employer pays the first $50,000, then the next $300,000 goes into WAYMARK, and that pooled premium of all the employers pays that claim for up to $300,000, and then the excess of that is passed to the reinsurance company. So in this example, the reinsurance company is paying $250,000 as opposed to $550,000. Yet they are collecting less premium for that payment. Here's another visual that takes one claim and one example and then starts to show kind of the power of how WAYMARK works. In this example, we're looking at 5 employers. Now we anticipate that WAYMARK's going to have significantly more than 5 employers in it. But just to show you how this shares, you've got a company here, $50,000 spec, that's their choice. You have another company here, $150,000. These companies all have the flexibility to choose how much risk they want to take on in their health plan. And they still retain inside each of their own companies the amount of risk that they choose, yet we all share that $300,000 corridor. So what we're talking about here is this kind of collective amount of the dark blue line that goes across all these employers. That's essentially 60% of the premium. We retain that at WAYMARK. We pay out claims as they're incurred. And if we outperform the premium amount, the excess premium is eligible to be returned back to the employer. So we're kind of earmarking dollars that says, hey, we don't want these dollars to be gone when we spend them. if we don't spend them. We only want them gone if we spend them. If we don't spend it, we want it back. And in today's environment, there's not an opportunity to get that premium back. So what are we trying to do? If you guys have read Jim Collins' Good to Great, one of the things he talks about is the flywheel. And the flywheel is the idea of adding more action to key elements of any kind of objective with the idea that once you start to gain momentum, that flywheel spins faster and harder and produces more results. What we're trying to do with the WAYMARK Collective is get here from kind of the left side, employers who are committed to things like optimizing fixed costs, actively managing their risk, and driving down overall claims utilization through kind of appropriate behaviors. So we work currently with like 600 different companies. They all have different tolerance for encouraging different behavior out of their members. So some might choose to do like a small narrow network that's known to be high performance hospitals or high performance doctors. Some may require that employers do biometric screenings or participate in a wellness program. What we recognize is that there are definitely actions that employers can take to produce better results than the market. And what we're talking about in WAYMARK is, how do you start to create a club of these employers who are interested in continual optimization of their risk, of their fixed costs, and their employee engagement, and then apply those activities again and again and again as the collective continues to grow in such a way that we outperform the current market. So right now, if you're an individual employer and you're buying insurance from Anthem or United Healthcare or fill in your favorite, you are being underwritten in a community of Greater Cincinnati that is inclusive of every employer inside that market. The good ones, the bad ones, the healthy ones, the sick ones. In our geography and the demographics of this geography drive kind of an underwriting basis. And what we know can happen is if you take a subset of the population, the WAYMARK Collective, you apply like-minded employers who are committed to applying kind of pressures in cost containment and risk management, and you go to market with that kind of volume, the carriers will compete for your business and the results will outperform the market. And as we talk about outperforming the market, that creates the opportunity to earn return of premium back. If you do better than the rest of the market, you should get money back. Any questions here? I want to pause for a minute. And
Dominic, let me just interrupt. And one of the things that we talked about and have talked about throughout this process, and again, this may be an inappropriate generalization, but I think there's a belief that, again, because of European lifestyles, philosophies, approaches to work, and so forth, we have a suspicion that European companies investing in the United States may indeed have better healthcare outcomes than their American peers. We don't know that for a fact. So in some ways, this is kind of a bet. And if European companies believe that by coming together, that they can generate better outcomes, and not just European companies, those that want to participate in this, but that they can generate better outcomes. I mean, so in some ways, this is a little bit of a test to take that belief to the market and see if people will buy into it. Correct?
Yeah. So I mean, in theory, I think that kind of comment is interesting, and yeah, I think that you can go over to Europe and see they seem to be in better shape than us. That's for sure. I don't have any data supporting it, but in theory, what we're saying is, if that's true, and not just true of European companies, this could be any company. You might be on the line today and say, well, my company is pretty healthy. Okay, well, if that's true, this tool will prove that to be true. You will outperform the market if you're healthier than the rest, if your costs are lower than the rest, if you're more aggressive in risk management and cost containment than the rest. This tool will prove it. And when you prove it, you will earn back premium. And so
Right.
I think that it's a wonderful kind of theory. And what we're trying to do is find that club of employers who says, let's take this on and we're going to produce results. And the more results we get, the more we're going to step on the gas to get more results, you know, and create this flywheel effect.
I see there is one question that came in about the $300,000. How is that allocated to the entities? Is it based on head count, or is it allocated by company?
Yeah, so every company is properly underwritten inside WAYMARK. So as we look at kind of your historical plan performance, your current risk, your current demographics, every employer is going to be assigned basically an expectation or guess as to how many claims that they're going to incur in that $300,000 segment. Every employer shares the same $300,000. So $300,000 is like non-negotiable. Every company takes on that amount of share. And then, I mean, it's good. So if you've bought a $50,000 level of risk, it means, you know, that first dollar after 50,000, you're passing to the whole group. Historically, you'd be paying that yourself through your stop loss. Now you're spreading it across the whole group. So in some years, you might have more claims than you thought. If we think about that group of 5, let's think about how kind of risk stratification works. You know, 80% of employers are going to perform about as expected. So when an underwriter underwrites, you might see 80% being plus or minus a reasonable margin as to how they're going to behave. 10% of the groups might have a really great year. Hey, underwriters, you missed this. We operated way better than you anticipated. And 10% of groups might be the opposite. Hey, you underwrote us. You thought we were going to perform well. We really stunk this year. We had terrible claims. We spent way more than anticipated. So if you think about the example with 5 employers, any given year, 3 of those employers are going to be about where you'd expect. One of those is going to have spent way more. And historically, that company is going to get crushed on their insurance renewal. And so what you're kind of saying is, you know, 20% of companies any given year are expecting pretty significant surprises. If we can spread those out across the collective, the surprises should almost go away for any company. And in the year that you're normal, it's not a surprise, but what we see is every 3 to 5 years, you're that bad company, and then you're that good company, and then you're that average company. And so we're just trying to normalize. Does that make sense?
Eric, if that answered your question, great. And if not, go ahead and feel free to restate it. And I see he's, yep, okay, yeah, let's go ahead and move on then, Dominic.
All right, cool. So here's why people like this model. The employers get all the benefits we just talked about: stability, cost control, transparency, return of premium. Why the insurance companies like this model is because it simplifies administration and underwriting and drives more volume. So if you think about kind of that Costco model, people like to sell their product through Costco because they know if they get in, if I get into Costco, there's going to be a lot of people buying my product. And so the insurance companies like the collective because if you buy their product, we're going to buy a lot of it, and a lot more than any one company would do on their own. So with that, the insurance companies get very competitive in trying to earn the business of the collective because that collective makes their risk more predictable. So instead of having 10 individual groups, they've got one giant group of 10, and that makes them able to underwrite better and do it at a better price. And then why HORAN cares about this is ultimately it drives more value, more control, more transparency, and better outcomes for our clients and partners. So this is a kind of a win for everybody. The area that we carve out, like who loses? Somebody's got to like lose. The insurance companies who do not earn the collective's business are the ones that lose. The one that earns it gets a really great, awesome, high volume, predictable model. The ones who lose, lose. And so you're kind of going to market as a giant group, and you're trying to get the most competitive product. And now instead of having that spread across 5 carriers, you have one that has all of it. Our insurance partner in the collective is Berkley Accident Health. They're a stop-loss reinsurance company. They've been in this business for a long time. They're highly rated. They're currently running more than 30 stop-loss captive programs. They've been doing it for a number of years. And so they've got a long history and a proven record in this space. And for that, we have selected Berkley to be our partner in the collective, which is built on the chassis of a captive insurance program. I want to spend a few minutes as to some features in the WAYMARK Collective, and it's kind of foundational to the idea of the captive model. Clients who are insured through the WAYMARK Collective, first and foremost, serve as on the board of the collective. So one of the things that we really like about this model, if you think about the club is really operated by the club. And so you start to take back some control as an employer as to how the club is managed, about how you might require people to adhere to certain performance or certain actions that we know drive good results. What we're trying to do is say, what are the things that WAYMARK likes and wants to see from other employers, and then the employers get to kind of self-police that and also build out the future strategy. There is an annual review and strategy meeting with Berkley that they're currently domiciled in North Carolina. There's a possibility that these meetings on an annual basis will be in the Carolinas. A significant portion of that cost is already built into that premium, so that trip is more or less paid for. Berkley as a whole, those 30 plus captives also do an annual meeting in the Caymans. So not that we're all going to do that, but you have the option as a participant to go also see how other collectives are run and operated, and to take and share best practice. And we would expect that some of these board members would likely want to go learn and see best practice from across the country. So similar to what you were talking about earlier, Todd, the value of the EACC and connecting and sharing best practice is also being done at the collective level. What we're really talking about technically is a segregated cell that's owned by Berkley. So captive makes some companies a little nervous. I would consider this kind of captive light. We don't actually take on ownership of this captive. We're kind of renting a cell that is segregated for WAYMARK in Greater Cincinnati by Berkley, but ultimately Berkley owns the captive and is ultimately responsible for all financial risk, auditing, financial reporting, all that kind of stuff. There is a collateral element that is built into your premium that's paid on an annual basis and also returned on an annual basis. That would be, in the self-insured world, what we'd call reserves. There's an expectation that that money isn't going to be used, and if it's not, that's the first dollar returned back. And then surplus is distributed back to active members annually. So essentially 12 months of claims pay, 6 months after the close of the year, after all claims have been paid, books have been settled, any leftover surplus is then redistributed back to members. 3 key players. You've got HORAN, who's doing kind of pre-underwriting, day-to-day servicing, and kind of sales efforts. So this is our job to make sure we get enough volume in here to make it interesting. And then ultimately protecting on the front end the integrity of the risk profile. You don't want HORAN to bring a bunch of bad risk to the club right out of the gate. Berkley is providing the stop loss coverage, full and final underwriting, and at the end of the day, if this thing goes sideways, they're assuming all financial risk. The rates that they've published, the contracts that they've signed with their employers are final, and worst case is already out there. In some captives, if you are actually owning that captive and you overspend, you'll see what's like a capital call. In this scenario, that does not exist. And then SRS is Strategic Risk Services. They're kind of nationally and internationally recognized expert in the captive models, and they are layered in here for all compliance, tax and accounting audits. So these are the 3 main parties that make the WAYMARK Collective go. Kind of wrapping up here, if you see at the base here, a typical employer is an example. You'd say, here's one employer, they're spending somewhere between 200,000 and maybe 1.5 million on stop loss premium. And so you're going to market trying to get a good deal on, let's call it your 200,000 or $500,000 in premium with zero expected distribution. In our first pass of the collective, we had 24 groups go out in wave one of underwriting. And that 24 employer group represented 16 million in stop loss premium. So what we were talking about before, you know, why would the insurance companies care? Well, they would rather win one group of 16 million than compete for 24 cases of 200,000 or $500,000 a piece, of which they're only going to win, you know, maybe 20% of that at a time, and that gets kind of spread across a lot of carriers. So now they're competing for 16 million at a time. They like that, and they give better pricing for that. And then the expected distribution is based on performance. So if we can drive a good performance outcome, a portion of that 16 million comes back to the active employers. So just timing and next steps. All of this is new. It's set to be launched January 1st, 2021. Right now, we're in the phases of educating employers, understanding kind of their levels of interest, underwriting their risk. We have to have 1,000 enrolled lives in the program for it to effectively launch. We don't anticipate that being an issue at all. As I mentioned, that first wave had like 24 groups go through underwriting. We're currently up to almost 70 groups in underwriting right now. So I think that we'll kind of knock that out of the park. But the must-haves, this is, of course, self-funded health plans. You're purchasing your stop loss through the collective, backed by Berkley, and you've got to have more than 50 employees enrolled in your health plan. So the intent there is that all members need to bring enough premium to participate. It's kind of like the minimum threshold. Todd, you had a question?
And Dominic, just to be clear, so if my company today does not self-fund its health plan, if we're fully insured, let's say, but I wanted to join WAYMARK, you could help me move to self-fund so that I could become a part of WAYMARK, correct?
Yeah, that's a great question. So a lot of employers who are fully insured today, who may have considered self-insurance, generally talk themselves out of self-insurance because they're afraid of the worst case scenario. What if I'm the employer that has way more claims than I anticipated, and now I'm getting crushed? This actually is the perfect methodology to convert from fully insured to self-insured, because it takes that worst case scenario and it smooths out that concern. So we would argue that jumping over that second step, self-insurance, especially for a smaller employer, this is the ideal model to do that. And we would gladly help an employer understand how to do it.
Okay.
So we're currently in kind of a pre-launch phase. We're collecting contingent quotes, meaning these are preliminary quotes. In the insurance space, there's still enough time left in the year that they don't want to put final rates on and then see, you know, claim behavior change in the next few months. So what first step is contingent quoting, and then just additional education. We're meeting with a lot of employers to talk through what this looks like for them and answer their questions. The kind of real launch comes in October when we confirm up stop loss quotes and disclosures. That means we're getting final pricing. And then employers do have to go through a small kind of enrollment process and contract process with the captive, which is actually, you know, the WAYMARK captive domiciled in North Carolina, operated by SRS and Berkley. There is a contractual element to that that'll be done in October. And then come October, December, that's like the regular preparation for implementing any new carrier or program in your health plan. So binder checks, applications, making sure the plan documents are right, final census, making sure that you know, coverage is intact and employees are prepared to have the appropriate coverages, all for January 1. So we talked to Todd about maybe having some extra time at the end. Looks like we were able to kind of fly through that pretty quickly. Don't know if you've got any other questions you want to pose.
Yeah, just again, if anybody has any questions, please let us know. Use that Q&A box. Dominic, again, I think what excites me most about this is the opportunity to see companies, and I think of our membership profile, you know, the companies that are interested in that European trade, particularly companies that are in advanced manufacturing. I mean, I have a belief that, you know, they have a different attitude towards caring for their employees as I have engaged with them, you know, in this position. I've seen that. I know some of the companies are actually quite generous on health benefits. Your comments. I mean, just the one thing I will say is that I had to travel to Amsterdam when we launched the Amsterdam chapter of the EACC. I took my father with me. He said, he asked me the question, he'd never been to Europe or to the Netherlands before. He said, what am I going to notice? I said, here's the thing that you're going to notice. In the Netherlands, nobody is fat. They walk everywhere. They ride bikes everywhere. There are no fat people. And it's just, I mean, that's just who they are. And again, Italians, I mean, not a lot of fat Italians. You know, just given the obesity crisis here, it's always reminded me of, again, how European attitudes, I think, will indeed generate better outcomes. And so the EACC is very excited to be a part of this, to see if we can help companies come together and take advantage of that and find better health outcomes for their employees and better financial returns for their companies. So, so we're very grateful. I mean, I'm very grateful to HORAN for taking this on. I'm excited that the EACC can be sort of a catalyst to bring companies together to bring this to fruition. I don't see that we have any additional questions. What we will be doing, for those of you who are interested, we will send around a recording of this webinar afterwards. We will send around the slides to those who registered. And of course, if you have any questions about the WAYMARK Collective or any other topics, please be sure to let me know. You can reach out to Dominic. I see one last question that's come in. Eric asks, how are members selected? How do you ensure that the group is not heavily weighted with companies having bad claims history? I mean, you talked a little bit about that in terms of that's your role, is to make sure that you're getting the right companies, right?
Yeah, so I would imagine, consider this kind of a multi-year process. We first and foremost do need volume that for the most part is good volume. So the initial entry will probably be a little bit more loose than over time, but it's all still properly underwritten. So maybe you're not the best risk today, but you should be priced appropriately. So there is an element that still requires being priced appropriately. Over time, as we get more volume, back to that flywheel effect, like we'll get tighter and tighter on the parameters, we'll get tighter and tighter based on the idea that the board wants to do that. So at first, I'd say it's probably a little bit more loose, and then it'll tighten up and tighten up and tighten up, and as it tightens up, those returns will improve. So for now, to answer that question, it'll be underwritten appropriately. If it's priced competitively to market, it should be a fair bet. What we would normally see is the groups you don't want in either won't be competitively priced, or they'll have laser liability, or they won't see this thing as even being an option.
But the point is that the owners of the collective, the companies that are a part of it, will actually have say in who gets in and develop those parameters over time. Is there a mechanism to take companies out?
Well, what'll normally happen when they get taken out is, you still are renewing each year, and companies are getting an insurance renewal. So in a collective, what you're trying to do is renew the aggregate at some number. So maybe one company deserves a 10 and one company deserves a 2, and the aggregate number is like a 4.5, right, or a 5. So what the board does is has the ability to take an aggregate number and help Berkley allocate those funds. So if you've got a company that runs poorly one year, you might not give them the 10, you might give them the 5, right? But over time, if that continues, you might give them the 10, you might give them the 14, you might give them an 18. At some point, you have some control over how that premium is distributed back through renewal, and ultimately, you'd likely price them out of competitiveness.
Right. So you wouldn't necessarily be able to vote them out, but you could price them out.
Yes. And you don't want to do that after like 1 year, because that's the whole point, right? Like,
of course,
1 year you want to be good, maybe even 2 years. But if the thing continues to just blow up the effectiveness of the pool, at some point, yeah, you might need to price them out.
Makes sense. Good.
All right, Todd, thank you. We will have this recording to share out to members, and really appreciate you having us. And
it's a great pleasure. I mean, as I said, we're very pleased to have the opportunity to share this with our members. We'll continue to promote this. If any of you know other companies that you think should be made aware of WAYMARK, be sure to reach out to Dominic or to me. Oh, one last question. Any industry specifically excluded? I'm assuming not. I mean, this is open basically to any company, right?
yeah, it is. And really, we didn't get super into it. While we're talking about the European companies, the first stage is getting volume. So, go back to the Costco model. The first thing that we need is to be able to buy in bulk. Over time, what sometimes occurs, again, up to the direction of the board, is that sometimes the board selects to move in like a segregated kind of model, where maybe you start to specify industry, maybe you specify, European companies, maybe you specify some vertical that you like. So there's pros and cons to all of that. Sometimes having similar industry makes it very easy for everybody to understand the business climate or whatever. Sometimes being, diversified across industry allows, in tough economic times, think about COVID. Some companies aren't doing hot, some companies are doing better than ever. And so, again, up to the board. The current moment, volume is more important to us than necessarily industry specific, but that's a great question and could change over the next 3 years.
Yeah, well, it's a good spot to finish. Just a reminder that this is not exclusive to EACC member companies for exactly that reason. Although clearly, we're targeting this at EACC members. That's our target market, and over time we could certainly move in that direction. But yeah, as you say, I mean, to get this off the ground, we're going to keep the doors open relatively wide.
Correct.
Dominic, thank you so much for the time. Shannon, the entire team at HORAN who helped to put this together, to our Italian companies that were really kind of the genesis and sort of the grain of sand in the oyster that has created this program. We're also very grateful. As I said, we'll send out the recording, we'll send out